Just ahead on Money in Your Pocket, we're talking insurance with Mark Donaldson from Dimond Brothers Insurance. Do you need insurance? What kind? How much? And with whom? Mark will also share some tips on how you can save money, and you might be surprised about one of the ways you can do that. That's all coming up next, so don't go away.
This program is made possible in part by Credit Union One, proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.
Welcome to Money in Your Pocket. I'm your host, Lori Casey, and today we're talking about insurance. And Mark Donaldson from Dimond Brothers Insurance, the CFO, joins me today. Welcome.
Thank you very much. Thanks for having me.
We've got a lot of stuff to cover, but first, Dimond Brothers is an independent insurance agency, correct? Mm-hmm. What's the difference between that and what you call a direct writer company?
Yeah, if you look at in insurance, it basically breaks down into two camps. There's the independent agency system, which is a system that allows for the producers within that agency system to shop multiple companies. They do not work for a specific company. They essentially act as a liaison between the companies and the consumer, similar to like a franchise arrangement. When you look at a direct writer, which most people will be familiar with, the big names, State Farm, American Family, Country Financial, those are companies where the people who distribute their product work specifically for that company.
Okay. Watch TV anytime. There are tons of commercials for insurance. That's actually become, we've got a Geico and a duck and a lady with big hair and theme songs. Insurance has really changed over the last 20 years. Why? What's changed and why?
Obviously, we've got a smart buying public. I think the buying public is getting more and more informed, and we live in an information age where you're able to go out and shop so many different products before you ever even step foot in a store, and you kind of learn everything about them before you even go in there. That what's happened is the insurance world has been part of that and providing a lot of information about the products available to the average consumer. And as a result, it's become kind of a commoditized product in that it's no different than going and buying milk off the shelf. What the large insurance companies that spend billions of dollars on advertising every year would lead you to believe is that homeowners insurance is homeowners insurance, auto insurance is auto insurance. You can do this on your own. You can shop 24 hours a day, 7 days a week in your pajamas if you want to, and you can go out and get this product. And because of that, there is obviously a big fight going on for the dollar that consumers spend, because it's a huge industry, obviously, from just the standpoint of homeowners and auto insurance. It's billions and billions and billions of dollars a year that consumers spend.
So what, if we are shopping for insurance, what should we be looking for as consumers?
One of the things that I guess there'd be a few different things that you look at. Most people are very familiar with the fact that they're going to need homeowners insurance, and the bank's telling them they've got to have that if they own a home and they've got a mortgage on it. The state's telling them they've got to have at least liability insurance on their auto, and so they're going out and they're shopping for those two products. The things that typically you would look for is obviously you want to deal with people that you trust, and a lot of times that is that person who's there in your community. They're the people that you go to church with. They're the people that you attend baseball games with and high school sporting events with and that sort of thing. So you're dealing with somebody you trust. You want to deal with companies that you're somewhat familiar with, or at least you can do your research on. There is the AM Best company is a national financial rating company that takes care of rating insurance companies, and they determine whether they're financially strong or they're going towards insolvency on a great scale. But that would be something else that you'd want to check out. And then obviously just inform yourself about what types of coverages are available. I would argue that homeowners is homeowners, auto is auto, but there are a few changes within those products that you ought to be aware of before you ever step foot in an insurance agency.
So how can you, when maybe you're out shopping for auto insurance,
Sure.
Can you really compare apples to apples, or are there certain things that are kind of with every car insurance sort of thing and then it gets customized after that?
Sure. We hear the term apples to apples a lot. Consumers will oftentimes come in and they'll say, give me an apples to apples comparison, or give me exactly what it is that I have. Essentially what they're saying is, I want the exact same coverage that I have, but I want it at a cheaper price in most cases. And from the apples to apples side, there is a way to really compare based on the skeleton of the policy, as I'll call it. So when you're dealing with, for instance, you mentioned auto insurance. Auto insurance has a few major coverages in it. It has liability, which is the coverage that provides you coverage in the event that somebody sues you for injuring them physically or damaging their property. You have medical payments coverage, which is coverage that pays for you and passengers of your car for medical attention that they need as a result of an auto accident. There's uninsured and underinsured motorist bodily injury coverage, which pays to take care of your physical injury in the event that you're hit by an uninsured or an underinsured motorist. There is, in Illinois, comprehensive insurance coverage, which the most typical thing people think of that is deer collision.
Yes.
When you get a deer attacks the side of your car, that's the coverage. And collision coverage, which is when you are in an accident and you're the person who essentially was the cause of the accident, it pays to repair your vehicle. Those are the skeletons of the policy, or that's the framework of the policy, and you're going to have those things from company to company will be the same. But there are small changes or small variables in coverage that might, one company might give you $10,000 in medical payments, another company might give you $5,000, or another company might give rental reimbursement at $35 a day, another company might give you $50. So there's going to be small changes, but the framework should be the same.
So it comes down to, a lot of times, do you want a higher deductible
Sure.
or lower deductible? Do you want rental, if you have to rent a car, that
Sure.
sort of thing? So I know you get this a lot. People say, Mark, how can I save on insurance? What are some things that people can do that they might not even realize?
Sure. I would say first and foremost, the thing that most people need to keep in mind is they purchase insurance for the unexpected larger losses. And sometimes when we're dealing with consumers, a lot of times we'll hear, I don't even use my insurance. And that's kind of the goal,
Yes.
quite honestly. The insurance companies are looking for people who don't use their insurance on a regular basis. So, if you have small claims, you have a windshield claim, it's probably better off to try to have that glass fixed or repaired as opposed to replaced. Or in the event that you've got a $250 deductible on comprehensive and the windshield's going to cost $300, you're probably better off just paying the $300 out of your pocket. So, watching your claims, watching what you submit to the carriers is definitely one of those things. One of the things that you definitely want to do is maintain your credit. And that might sound crazy, but as I mentioned before, we live in an information age, and insurance companies are looking at so much information. And you have companies out there, obviously major search engines that are out there that are monitoring, where you live, how much money you make, where you spend your money, how you spend your money, what's the average size purchase that you make, all these different sorts of things. And the insurance companies are gathering all that information and they're plugging it into a rating engine and determining that, well, if Lori spends her money at this store and Mark spends his money at this store, we think Lori's a better or worse insurance risk than Mark. And it's that exact to the point where most of your rating systems now with companies will tell you they have 2,000 to 4,000 data points that they are looking at in the background to determine what your insurance rates are. So, when you're late on that credit card payment or you're late on your utility bill payment and it's reported to a credit rating bureau, it will have an impact on your insurance.
That's interesting because oftentimes we think of credit ratings comes into play when you want to get a loan for a house or a car, and I never thought that would affect your
Absolutely.
insurance. Let's talk a little bit about insurance through different stages of life. And I think, obviously when you get a car, you deal with car insurance. We know that. But think about, our younger, college students or people just getting out into the world.
Sure.
They don't often think about renter's insurance.
Right. Yeah, I would say probably that is, as far as a real property coverage, that's probably the most underused or underconsumed product around. Most people, again, the state's telling them they've got to have auto insurance, so they're purchasing that, or they're, in most cases with an 18-year-old, the parents are purchasing the insurance for that child. But once that child becomes a young adult and they are either going to college and they're living in an apartment, or they are maybe getting out of college and going to their first job, they are renting an apartment someplace and they've got, it varies obviously from person to person, but they might have somewhere between $5,000 and $20,000 of contents that they've got inside their apartment, and they're not even thinking about insuring it. A lot of times, unfortunately, a lot of people assume that in the event that my apartment building burns down, my landlord's going to pay to replace my contents, and that just doesn't happen. So a lot of companies have even went, and I would suggest to any consumer, especially young consumers that are going out and all they have is an auto insurance policy, is asking if renter's insurance can be endorsed to their auto policy. policy because that is available.
It just means added on to.
Right, they just put it on as a line item. It's generally very cheap that way. Gives you good coverage, but very economical. If your company does not offer that, then just ask them about a renter's policy and say, I need a flat amount of $25,000. And again, it's pretty economical, $100 to $200 a year generally to protect your contents.
So renter's insurance, and we've kind of covered car insurance, and maybe you're buying your first home.
Sure.
Obviously, the mortgage company requires homeowners insurance.
Sure.
So what are some things we need to think about in terms of homeowners insurance?
Yeah, homeowners insurance, one of the things that, all policies have a coverage A, what we would call within the industry a coverage A, which is just simply the replacement cost or rebuilding cost of the structure that you live in that you call your home. That oftentimes causes a lot of angst among consumers because they're thinking always market value, and market value really has very little to do with it. It's generally rebuilding cost. So you might have purchased your home for $170,000, and yet the replacement cost on it, or rebuilding cost, is $320,000. The insurance company is going to have to insure it for the rebuilding cost.
Okay.
And so that can vary from company to company as far as what ratings they use to establish cost per square foot of reconstruction, but all policies are going to have a coverage A. They're also going to have generally coverage on your personal property inside. That's generally at 75% of your building limit. So if you have a $300,000 home or a $400,000 home, you're going to have $300,000 of personal property insurance on the inside. They also have appurtenant structures, which cover your standalone sheds, your garages, things like that. If you have anything out there along those lines, there's some of them that provide coverage. Most provide coverages for trees and bushes up to a certain sub-amount. So if you have a windstorm or a lightning storm that comes through, there is very, very limited coverage for that. But some companies do provide coverage for that. So those are going to be, as we talked about in the auto policy, the framework. The framework for the policy for the homeowners is going to be very similar, and it's going to have several standard coverages from company to company. The liability being the last part of that piece. But then when you get into the actual fine details of the policy, there might be differences. So let's say that you have a finished basement, and you would want sump pump or sewer failure to cover what happens when the sewer comes up through the basement floor.
Yes.
That's generally going to vary from company to company. Some companies will provide you $5,000, $10,000, $15,000, up to $25,000. If you have a very high valued home and have a lot of improvements in the basement, you might talk to your agent about getting additional coverages. One last thing I'll mention in regards to homeowners, and this is something that's extremely important, is jewelry or guns or fine arts.
Okay.
Most of those are covered at a specific sublimit on the policy. And they are only covered for the perils that are on the homeowner's policy, so that's the standard perils, fire, wind, theft, those sorts of things. If you have any high-valued firearms, any high-valued fine arts, any high-valued jewelry, those really ought to be scheduled on your policy.
Okay.
They will put it on what we call an inland marine floater, but it gives it essentially very, very broad coverage, even will cover for mysterious disappearance. So you're washing the dishes and your wedding ring falls off, goes down the garbage disposal. It's covered.
So that's like a separate thing that you
Correct.
should consider.
Be an add-on. Yeah.
Okay. So as life moves on, maybe we have kids, we get older, we start thinking about life insurance.
Sure.
And this confuses a lot of people. Let's talk a little bit about how life insurance has changed in the last 20 years.
Sure. Yeah, generally, I think a lot of people, I'm 44 years old, and when I think back to my childhood and even talk to my parents about it, life insurance was very much almost like a door-to-door type sales where you had people showing up and it might have been a person that you knew, might have been the person you didn't know, but they would come in and they would say, you need to buy some whole life insurance and you're going to establish cash value in this, and this will be something that you'll have forever, and when you get to retirement age, you can pull out this cash. Wouldn't say that necessarily it was sold in as an investment, but the way it was presented kind of led people to believe it was an investment. And as a result, whole life has kind of gotten a bad name over the years. When you look at interest rates in general in banks, whole life's not too bad of a place to put your money, but at the same time, the biggest error people make on whole life is that they go with whole life, they get a fairly large premium, but they don't get the coverage they need. Okay. And so what you've seen over the last several years is really this transition from whole life into a universal life product, and then also this term product. Universal life is a product that kind of combines whole life and term together, allows you to build some cash value, but gives you a large death benefit. Term is the exact opposite of whole life. It gives you that large death benefit, with no cash value. So it's going to last you, maybe you buy a 10-year term, and that means the premiums are going to stay level for 10 years. Maybe you buy a 20-year or a 30-year. That's generally when we see young couples buy insurance, they're looking for term insurance. There's several, nationwide financial talk shows that definitely recommend term, and so you see more and more people gravitating towards that, and that's where you see, or you hear on the radio, hey, you can buy $500,000 a term for a 43-year-old non-smoking male for X amount.
So how does that work? Say I want a $100,000 term life policy, and I'm 25. I'm not 25 anymore, but at 25, I decide that's what I want to do.
Sure.
How does that work?
Generally, with the $100,000 policy now, and again, you were talking about how things have changed, is that $100,000 used to be a lot of money. Still is to me, but
yeah, me too.
But $100,000 used to be a lot of money, and as a result, the insurance company would underwrite that, meaning that they would generally take blood work. They might even do an EKG. They're going to do a full medical history. They're going to order a paramedic exam. And now what you're seeing is if you want $100,000, in most cases, you're going to answer a few questions, and you're going to get that $100,000 policy. The bar has been kind of raised on that, so now you're looking at companies that used to really look pretty stringently at $100,000. They're maybe scrapping that whole idea of looking really intently at that, but maybe they're doing the same thing at $250,000 or at $500,000. Okay. But essentially, the process is you say, I want $100,000 of insurance. They fill out a short application on you, send it off to the company binds the coverage, and at that point, you're covered for $100,000 in the event of your death.
Pay a certain amount every month until when? Forever?
Generally, what you would do is you would take out a 10-year term, and it would be a 10-year level term or a 20-year level term or a 30-year level term, and that means that you would pay that premium for, could be on a monthly or an annual basis, but you would pay that every month for 10 years. At the end of 10 years, the company has the right to re-underwrite it at your new age. So if you took it at 24, they're going to renew it at 34, but now they're going to renew it at a 34-year-old rate. In most cases, you're better off just reapplying for coverage and getting a new policy for a new 10 years or 20 years. I can tell you personally, what I have done is taken a 30-year policy, and I took out a 30-year policy when I was 30 years old, a 30-year policy when I was 40, and when I turn 50, I'll do the same, so that during the time when my family is most at risk for loss of my income, we're covered at the highest amount, but eventually those limits will fall off.
So does that build value then, or does it just
does
stays
not.
at, so if you buy 100,000,
it stays at 100,000.
Okay, so then I forgot already, that's term.
Right.
Whole life, how does that work then?
Generally, whole life establishes a death benefit that does go up.
Okay.
It will incrementally go up, but it incrementally goes up generally according to what the cash value in the policy is. So as the cash value is developing, it's added to the death benefit, which gives you a larger amount. And that's actually permanent insurance. They call it permanent insurance for a reason. It stays in place until you die, even if it's 95.
And then you had mentioned universal. It was kind of a combination of both of those. Can you kind of explain
Sure.
how that works?
Yeah, the idea would be if you came to me and you said, hey, I'd like to purchase $500,000 of insurance, but I can't afford $500,000 in whole life premium. I would like to have something, though, that gives me some cash value. So what I might suggest to you is saying, Lori, why don't we take out a UL policy or universal life policy that has $400,000 of term insurance and $100,000 of whole life. And so you're going to begin to develop cash value on the whole life portion of that policy, and then you couple that with the $400,000 policy. So you're getting the protection you need. You're also getting at least some growth on your money.
Okay, and now here's the million-dollar question
Sure.
that I'm sure you get asked. How much life insurance should I have?
That is something that people ask quite often. And I think you kind of have a consensus across the industry, which has been virtually, and this isn't scientific by any means, I think it's probably just to take some of the guesswork out of it, but 10 times your annual income is a good thing to start with. A true life insurance agent will sit down with you and say, Lori, tell me about your debt. Okay, how much do you owe on your car? How much do you owe on your house? What do you want to set aside for your kids for college education? What do you want to do? How much do you generally spend per year on these consumable items? And let's come up with a number. And in fact, some of them see the value in that, and that they will come to you and say, Lori, what you need is $456,317 of whole life insurance. That works for some people. Most people, it's, hey, listen, if I just know I've got 10 times my amount or 10 times my income amount, I'm good to go.
I'm fine with that.
Yep.
Is insurance something that you should review on a regular basis?
Sure. Yeah, I would definitely suggest looking at your insurance policies, and that means your auto insurance, your home insurance, your life insurance, even your health insurance on an annual basis. There can be a lot that changes in the course of a year. You have a youthful driver that gets added onto the household, and you're not even thinking about it, and you forget to put that driver on the house or on the household drivers list, or you buy them a car and you forget about it. Now that shouldn't happen because the state's checking in the back, but that does happen. You put an addition on your house, you forget to call your agent. And so it's a good thing to really look at that on an annual basis. Most policies renew annually, and just on 30 days before your policy is going to renew, is sit down there with a person who knows you and say, am I missing anything here? I'm looking at my house, this looks adequate to me, but am I missing? Oh yeah, don't forget we put the gazebo up in the backyard last year. Yeah. That's right, I forgot about that. Or we have a situation where maybe we have an increase in exposure, we put a swimming pool in, or we have a trampoline, or those sorts of things that we need to be aware of and make sure that we're properly covered for. And so when you look at that, you might have a situation from the life insurance side where you've taken a job change and your income has went up substantially. Well, now there's more of a risk for loss of that income.
And I would assume, especially in life insurance, it's good to keep track of who your beneficiaries are.
Sure.
If those people maybe pass away or maybe have a falling out or something, don't forget about that as well.
Yeah, it's funny you mentioned that, and it's not only just with life insurance, but how many times a husband and wife are listed on a personal lines policy together and they get divorced. And the one spouse forgets to remove the other spouse. And that in and of itself is a bit of a problem, but it becomes more of a problem when there's a claim, because guess who they cut the check to? Both parties.
Okay.
So now that spouse is having to go to their ex-spouse and say, hey, can you sign this claims check for me? And you get into situations where the other spouse says, I don't think so. Don't think I'm going to sign that. And so then you get into a battle secondarily off of that.
Keep those beneficiaries and all those things straight. Another question here. We're all about saving money here at Money in Your Pocket. Do you save more money by having your insurance all with one agent or company versus having a little here and a little there? That's
a great question, because a lot of people, especially if they're in a small town, they like to kind of spread it around a little bit and say, well, I know so-and-so down the street, they've got an agency, let me insure my home there and my auto here. But you certainly do by bundling the products. Auto home insurance generally, if you have both of those with the same company, you get substantial discounts off of both. There are some companies actually out there even that will give you additional discounts if you purchase life insurance. So you can purchase the life insurance, the auto, the home, all from the same company, and you're generally getting somewhere between a 15% to 20% discount on all the lines because you've got them all with one carrier. There's even carriers out there now, there's very few, but a few, that if you have a business and you insure your business and your auto and your home and your life all with one carrier, they give you multiple discounts on all lines.
All right, well, Mark, we're all out of time.
Sure.
You've done a great job of explaining, especially the life insurance. That has always confused me. And given us some great ideas on how to save money through insurance and some things that we as consumers need to look out for. So thanks for stopping by. We didn't even get to health insurance, so we'll have to have you back again for that discussion.
That sounds great. Thank you for having me.
Thanks, Mark.
Thanks.
Here's this week's bottom line on insurance. First, do your research. There's plenty of resources out there. The more you know what your needs are, the better your needs will be met. Next, compare policies and remember that it's not always going to be apples to apples. As your life changes, make sure you review your insurance policies to optimize your coverage. And finally, remember that insurance is here to protect you from the bad things in life. So if you don't use it, that's a good thing. Thanks for tuning in this week. We'll see you next time for more information and advice that can put more money in your pocket.
This program is made possible in part by Credit Union One. Proud to support Money in Your Pocket. Credit Union One offers savings and lending options. Additional information on membership available at creditunion1.org. Loans subject to approval. Accounts are insured up to $250,000. By member's choice, this institution is not federally insured.